Hello everybody, welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thank you for joining us. So we sit here on the eve of the potential government shutdown. Both sides haven't yet come to an agreement about keeping the government open. And so, there's maybe some volatility, small amount of volatility in the markets around that. But markets, when you look at them generally, they're not all that concerned about the government staying open and at some point getting a deal, and neither are we. If you look back historically when this has happened, a deal eventually gets reached and the government stays open, and stocks, I think, are pricing that in and would be much more volatile if stocks were worried about it. The market in general was worried about it. So I know maybe that's on some of your minds, but it's not really an event as far as the market's concerning yet. And so what we actually wanted to address in this e-news video was in our last e-news video, Josh and I talked for 6 minutes, and in the last 20 seconds, we just sort of said, we haven't had any stock market volatility to the downside and that you should expect some. And the response we got based on that last 20 seconds was very overwhelming, meaning we got a lot of requests for meetings and phone calls and emails. And so if we got that many, we know a lot more people were actually thinking about the potential volatility that is out there. So here's the deal, though. It's sort of like if you go back to COVID or you go back to 2022, even if you know those markets were going to happen, if we knew we were going to get a 20% correction in the next 6 months, we still wouldn't do anything about it with your portfolios. So you remember these corrections, like a lot of you probably don't even remember that the S&P was down 22% in 2022. That's like a distant memory, but it happened. And at the time, it was unnerving for a lot of you. Or that COVID markets went down over 30%, 34% in 19 trading days, but markets rallied off that. So, we're going to get a correction, but it doesn't mean we're going to do something about it. Remember, we have diversified, high-quality portfolios for that very reason, and we can't time this, right? So, this is one of those deals where I get the sense that you're like, whoa, wow, this thing has gone up a lot, and it seems frothy. But, we're going to get a correction, but I don't know when it's going to be and how long it's going to be. And there's nothing to do ahead of that. You have to stay invested. And so if you need to take some risk off the table, we understand that. That would be the time to do it now. But doing some binary decision, all in or all out, based on something that may or may not happen, you're never going to be a successful investor by doing that. So remember, it's time in the market rather than trying to time the market, which is how you'll be successful over time. And so this period reminds us a lot of the late 90s, and Josh can sort of address that and the solution that we have for your money.
Long-term investors in the stock market will sort of feel echoes from the past and sort of look to the analog of the tech telecom media bubble that sort of percolated in the late 90s and then finally blew up in the 2000s. And the AI hype phase right now, it's very similar in the sense that there's massive amounts of capital expenditure being made by large S&P 500 companies. Whether or not those investments are going to yield profits on a timeline that is acceptable to Wall Street and quarterly earnings reporting, unless we change that, of course. Just halfway joking there, but whether or not those profits are going to materialize on a timeline that is acceptable to Wall Street, I think everyone knows that eventually there's going to be some disappointment there. The big question, of course, is how quickly we get to that sort of digestion phase where investors demand profits over the potential of future profits. Of course, lower interest rates actually pushes that timeline further, and a lot of people will remember Alan Greenspan back in 1996 pointing to the irrational exuberance in markets. Well, markets kept going to the stratosphere for 4 more years after he initially cited that froth, which again harkens back to that idea of, we're never going to make investing or not investing in stocks a binary decision. The most important thing is time in the market, and you have to stay invested. We'll continue to act prudently and rebalance portfolios when equities kind of get ahead of their skis. But the main point I think to take home is that a well-diversified portfolio in the wake of the tech telecom media bubble where the NASDAQ fell 78%, portfolios that had international diversification, small amounts of real assets, real estate, small caps, mid caps, international developed, all the asset classes that all of you own, that portfolio persisted throughout the 2000s with a high single-digit annual return. And that's the intention. Is we have to stay invested through all markets, and we have to continue to perform through all markets. And so that's why ultimately you own what you own, and why concentration risk in the ultra long run doesn't actually pay off.
All right, if you have a question about your situation or your account, give us a call at the office, 800-743-0988, or you can email either one of us, Josh or Tyler, at northwestquadrantwealth.com. We'll see you back here in a couple weeks.